You're listening to The Intellectual Investor, episode number 1, The 6 Commandments of Value Investing, written by Vitaliy Katzenelson and read by Elliot. To read this article online or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. The 6 Commandments of Value Investing. I wrote the core of this chapter in preparation for a speech I gave at an investment conference. In my speech, I wanted to show how at my firm, we took the 6 Commandments of Value Investing and embedded them in our investment operating system. Since I was speaking to fellow value investors, this speech was written not to promote my firm, but to educate. I was going to rewrite the speech for this chapter and make it a bit less about us and more about you. But each attempt resulted in a dull chapter. So, here is a much extended version of my original speech. The 6 Commandments of Value Investing. Number 1. A stock is fractional ownership of a business, not trading sardines. Number 2. Long-term time horizon, both analytical and expectation to hold. Number 3. Mr. Market is there to serve us. Know who's the boss. Number 4. Margin of safety. Leave room in your buy price for being wrong. Number 5. Risk is permanent loss of capital, not volatility. And number 6. In the long run, stocks revert to their fair value. These are the 6 commandments of value investing. I don't expect any value investors reading this to be surprised about any one of them. They were brought down from the mountain by Ben Graham in his book Security Analysis. These commandments are very important, and they sound great, but in the chaos of our daily lives, it is so easy for them to turn into empty slogans. A slogan without execution is a lie. For these slogans not to be lies, we need to deeply embed them in our investment operating system, our analytical framework, and our daily routines, and act on them. Let me tell you how we utilize the 6 commandments in our investment operating system at IMA. Number 1, a stock is partial ownership of a business. The US and most foreign markets we invest in are very liquid. We can sell any stock in our portfolios with ease. A few clicks and a few cents per share commission, and it's gone. Though it can be tremendously beneficial, we wish selling a house were that easy, fast, and cheap. This instant liquidity can also have harmful, unintended consequences. It tends to shrink the investor's analytical time horizon and often transforms investors into pseudo-investors. For true traders, stocks are not businesses, but trading widgets. Pork bellies, orange futures, stocks are all the same to them. Traders try to find some kind of order or a pattern in the hourly and daily chaos or randomness of financial markets. As an investor, I cannot relate to traders. Not only do we not belong to the same religion, we live in very different universes. Over the years, I've met many traders, and I count a few as my dear friends. None of them confuse what they do with investing. In fact, traders are very explicit that their rules of engagement with stocks are very different from those of investors. I have little insight to share with traders in these pages. My message is really to market participants who, on the surface, look at stocks as if they were investments, but who have been morphed by the allure of the market's instant liquidity into pseudo-investors. They are not quite traders because they don't use traders' tools and are not trying to find order in the daily noise. But they aren't investors either, because their time horizon has been shrunk and their analysis deformed by market liquidity. The best way to contrast the investor with the pseudo-investor is by explaining what an investor is. A true investor would do the same analysis of a public company that he would do for a private one. He'd analyze the company's business, guesstimate earnings power and cash flows, assess its moat or the ability to protect cash flows from competition, try to look around the corner to various risks. Then, figure out what the business is worth and decide what price he'd want to pay for it. That is, your required discount to what the business is worth. For an investor, the analysis would be the same if his $100,000 was buying 20% of a private business or 0.002% of a public one. This is how your rational uncle would analyze a business, your Warren Buffett or Ben Graham. So how do we maintain this rational attitude and prevent the stock market from turning us into pseudo-investors? Very simple. We start by asking, would we want to own this business if the stock market was closed for 10 years? We have Warren Buffett to thank for that one. This simple question changes how we look at stocks. Now, the immediate liquidity that is so alluring in a stock, and that turns investors into pseudo-investors, is gone from our analysis. Suddenly, quality, valuation, cash flows, competitive advantage, return on capital, balance sheets, management, has a much different, more complete meaning. Number 2, long-term time horizon, both analytical and expectation to hold. A long-term time horizon is extremely important for value investors for several reasons. First, it is impossible to predict how a stock will be priced in the short run. Short-term stock behavior is random, and thus its forecasting, at least using tools available to investors, cannot be turned into a repeatable process. Second, having a longer time horizon than Wall Street is a very important competitive advantage. Wall Street's time horizon is very short, measured in months, maybe quarters, but rarely in years. Money flows into mutual funds, and hedge funds are driven by recent performance. So Wall Street is obsessed with the short term. This creates time arbitrage. Stocks get punished because their immediate future may look unattractive. But if you look at them as businesses, that short-term performance is just a pimple on your long-term timeline. So, how do we embed a long-term time horizon into our process? First, we always look at earnings and cash flows at least 3, often 5 years out. This forces us to look at the company's normalized earnings power and ignores the short term. All of our models focus on what the company will be worth based on its earnings power in 3 to 5 years. Then we discount and bring that future value forward to today at an 18% to 40% discount rate, depending on the company's quality, to see what we want to pay for this company today. Looking at the business at least 3 to 5 years out has a very important side effect. It adds growth to the portfolio from earnings and dividends. Stock returns come from 3 sources: price to earnings, or PE expansion, earnings growth, and dividends. PE expansion is finite. It's a one-time shot in the arm. Let's say a stock's PE goes from an undervalued 12 to a fairly valued 15, a 25% return. If this company doesn't grow earnings and/or pay dividends, that 25% will be our total return. The risk of owning this type of one-shot stock is that without earnings growth or dividends, time is not on your side. You don't get paid to wait. If your long-term horizon is 3 years, that 25% return gets truncated to an annual return of only 8% a year. But if this company in addition to trading at a depressed PE, pays a 3% dividend and grows earnings 7% a year, that is an additional, repeatable 10% return a year. This elongation of the time horizon embeds growth in our portfolio and also forces us to demand a much higher discount for stocks that don't pay dividends and don't grow their earnings. Number 3, the market is there to serve you, not the other way around. The market is there to price stocks on a daily basis, but it doesn't value them on a daily basis. In the long run, and the yardstick here is years, not days or months, the market will value stocks, but in the short run, stock price movements are random. Despite this randomness, the media will always find a rational explanation for a move. However, trying to understand randomness and predict stock movements in the short run is like trying to have an intelligent conversation with a 2-year-old. It may be fun, but it will consume a lot of your time and energy, and the outcome is far from certain. Stock fluctuations should be looked upon as a natural and benign feature of the stock market, but only if you know what the asset is worth. To make Mr. Market serve us and not become its slave, here is what we do. If we know a stock is worth $1, then if its price falls from 50 cents to 30 cents, a 40% decline, that is a blessing for several reasons. The company can now buy back a lot more of its stock at lower prices, and we can add to our position. After all, it's 40% cheaper. Here's the key though. You have to make sure that what you thought was worth $1 is still worth $1. To quote Mike Tyson, everyone has a plan till they get punched in the mouth. So how do you remain rational when Mr. Market has just smashed you in the face by repricing your $1 stock from 50 cents to 30 cents? Maybe Mr. Market is right, and that company's fair value was never really $1, but only 40 cents. To remain rational, we focus on maximizing our total IQ. I know we were not supposed to have math, especially this early in the book, but let me indulge you with this little equation. Total IQ equals IQ times EQ, where EQ is less than or equal to 1. Before I explain, I want to stress this point. Your IQ, EQ, and thus total IQ will vary from stock to stock and from industry to industry. Let's start with IQ. IQ, our intellectual capacity to analyze problems, will vary with the problem in front of us. Just as we breezed through some subjects in college and struggled with others, our ability to understand the current and future dynamics of various companies and industries will fluctuate as well. This is why we buy stocks that fall within our sphere of competence. We tend to stick with ones where our IQ is the highest. As I have mentioned before, but will continue to repeat, if investing were an exact science, or a formulaic process by which you could, in a vacuum, constantly test and retest your hypothesis and repeat your results, then EQ, our emotional quotient, would be irrelevant. If we were characters from Star Trek with complete control over our emotions, like Mr. Spock, or lacking emotions entirely, like Lieutenant Commander Data, then our EQ wouldn't matter. However, investing is not a science, and we are humans. We have plenty of emotions, and thus EQ is a very important part of this equation. Though we usually think about our capacity to analyze problems as being dependable and stable over time, it isn't. First, emotions distort probabilities. So even if my intellectual capacity to analyze a problem is not impacted, My brain may be solving a distorted problem. Second, my IQ is not constant, and my ability to process information effectively declines under emotional stress. I either lose the big picture or overlook important details. This dilemma is not unique to me. I'm sure it affects us all to varying degrees. A friend of mine who is a terrific investor and who will remain nameless, though his name is George, once told me that he never invests in grocery store stocks because he can't be rational when he holds them. If we spent some Freudian time with him, we'd probably discover that he experienced a traumatic childhood event at the grocery store. He may have been caught shoplifting a candy bar when he was 8. Or he may have had a bad experience with a grocery stock early in his career. The reason for his problem is irrelevant, though. What is important is that he has realized that his high IQ will be impaired by his low EQ if he owns grocery stocks. The higher my EQ is with regards to a particular company, the more likely my total IQ will not degrade when things go wrong, or even when they go right. This is why in the little formula above, EQ cannot be greater than 1. In your most emotionally stable state, where EQ equals 1, your total IQ will equal your IQ. There is a good reason why doctors don't treat their own children. Their ability to be rational and properly weigh probabilities may be severely compromised by their emotions. Now, how do we increase our total IQ? First, we increase it by subtraction, by shrinking our universe to stocks that lie within both our IQ and EQ comfort zones. We are very careful about stocks or industries where either our IQ or EQ is questionable. For instance, we have recognized that our IQ is low when it comes to non-revenue generating single future product biotech companies. We have zero analytical insights into this business. None. We find that our EQ is fairly low when it comes to complex financial businesses. We don't invest in any. The beauty of investing is that we only need 20 to 30 stocks, and we get to choose which problems we want to tackle. We usually like easy problems. In other professions, this is a luxury you don't have. If you are an orthopedic surgeon, you are not going to tell your patient that you only operate on right knees because the last time out you had a bad experience with the left. The second way we increase our total IQ is we look for areas where our EQ is the highest. Over the years, we've discovered that our EQ is much higher with higher quality companies. Therefore, for every company in our portfolio or on our watch list, we quantify quality. And with very rare exceptions, we own only very high quality companies. We quantify quality for another reason too. As value investors, we are innately focused on a margin of safety. We found that if you don't quantify quality, it is very easy to lower your standards when you reach for value, especially in a very expensive market. We went a step further. Quality for us is a filter. If a company doesn't pass its quality test, it is dead to us. It may have high growth prospects, pay high dividends, and it may sell at a mouth-watering valuation. But if it failed our quality test, it is dead to us. By quantifying quality, we can keep the overall quality of our portfolio very high. Just as importantly, we can keep our EQ high too. By maximizing both our IQ and EQ for individual stocks, we maximize the total IQ of the portfolio. Thus, when we get punched in the mouth, we are able to rationally reanalyze a stock and may decide to buy more do nothing, or sell. We cautiously guard our EQ and long-term horizon. We don't let the outside world come unchecked into our daily life. For instance, we spend little time watching business TV during the day, as we find it to be toxic to our time horizon and to our investor as opposed to trader mentality. For the same reason, we also don't look at our portfolio more than twice a day. We'll discuss this topic in greater detail later. Finally, and this applies to professional investors only, you need to have clients who will allow you to maintain your EQ. Following the 6 commandments is practically impossible if your clients don't believe in them. Here's a real example. On January 25th, 2013, at 3:55 p.m., I got this email from a client, David. Dear Vitaliy, I just noticed that you bought Apple. I feel this was an irresponsible purchase and want you to cancel the trade first thing Monday morning. This is a stock that is coming off a 1-year top and is heading down. You should not be trying to pick up a falling star. Thank you, David. David and I talked on the phone, and I tried to explain our logic. I'm not going to bore you with that, but it was along the lines of incredible brand, high recurrence of revenues, great management, a quarter of market capitalization in cash. We tried to kill it, we lowered its margins, cut sales, and we simply couldn't. I told David that the price of the stock is an opinion of value, not a final verdict. He didn't care. He talked to his neighbor, who was a famous technician, who said, Apple is going down. To which my response was, if it declines, that will be a blessing. The company is buying back stock, and we are going to buy more. The technician was right. Apple declined from $455, $65 split adjusted, our initial purchase price, to $395, $56 split adjusted. We bought more Apple as it fell. This encounter also made me realize how this negative psychology around Apple was creating an opportunity in Apple, and I wrote a 2-part article describing the aforementioned incident as evidence of that. What I did not say in that article is that we had to amicably part ways with David. I tried very hard to communicate the 6 commandments to him, but he was not willing to relearn. Keeping him as a client would erode my overall EQ and would have impacted other clients. Your mental state is as important as your ability to analyze a company's balance sheet or your ability to value the business. You may spend days sharpening your investment process, your analytical skills, but in the end, if your EQ is low, nothing else will matter. Number 4, margin of safety. Leave room in your buy price for being wrong. Margin of safety is a function of 2 dimensions: a company's quality and its growth. I am generalizing here, but exogenous events have a greater impact on a lower quality business than a higher quality one. Thus, a high quality company needs a lower margin of safety than a lower quality one. A company that is growing earnings and paying dividends has time on its side, and thus may not need as much margin of safety as a lower growing one. We quantify both a company's quality and growth, and thus margin of safety is deeply embedded in our investment operating system. The larger the discount to the stock's fair value, the $1, the less clairvoyance you need to have about the future of the business. For instance, in 2013, when Apple stock was trading at $400 pre-split, we didn't have a very clear crystal ball about Apple's future. Apple just had to be able to barely fog the mirror. In later years, at $900, we need to have a lot more precision in our analysis of Apple's future. Number 5, risk is a permanent loss of capital, not volatility. Conventional wisdom views volatility as risk, but not value investors. We befriend volatility, embrace it, and try to take advantage of it. For someone who has not researched a company, it is not readily apparent whether a decline in shares is temporary or permanent. After all, if you don't know what the company is worth, the quoted price becomes the quotient of intrinsic value. If you do know what the company is worth, then the change in intrinsic value is all that's going to matter. The price quoted on the exchange will be your friend, allowing you to take advantage of the difference between intrinsic value and quoted stock price. If the quoted stock price is significantly cheaper than your estimated intrinsic value, you buy it. Or you buy more of it if you already own it. If the opposite is true, you sell it. So what is a company worth? Determining the intrinsic value requires a combination of art and science, in that order. It is not quoted on the exchanges. We go about this the same way a businessman would figure out how much he'd want to pay for a gas station or a McDonald's franchise. Analysis of each company will be different. But at the core, we estimate the cash flows the business will produce for shareholders in the long run, at least 10 years, and what the business will be worth then, based on our estimate of its earnings power at the time. The combination of the two provides us an approximation of what the business is worth now. To further embed the right type of risk analysis into our investment operating system, we build financial models. Models help us to understand businesses better and provide insights as to which metrics matter and which don't. They allow us to stress test the business. We don't just look at the upside, but spend a lot of time looking at the downside. We try to kill the business. We look at known risks and try to imagine unknown ones. We try to quantify their impact on cash flows. This killing helps us understand how much of a discount, that is, margin of safety, we should demand to what the business is worth. By applying this discount to fair value, we arrive at a buy price. For every stock we buy, we probably look at a few dozen, at least. For instance, if we are looking at a company that is selling products or services to consumers, we'll be focusing on customer acquisition costs. We'll try to drill down to the essential operating metrics of each company. If it's a convenience store retailer, we'll look into gallons of gas sold and profit per gallon. If it's an oil driller, we'll look at utilization rates, rigs in service, average revenue per rig per day. If it's a pharmaceuticals company, we'll have revenue lines for each major drug it sells and model the company for the eventuality that the patents will run out. Revenues usually decline 80 to 90% when a patent expires. These models help us to understand the economics of the business. We usually build two types of models. We start with what we call the tablecloth model. This is a very detailed, in-depth model that zeroes in on different aspects of the business. But the risk we run with the tablecloth model is that we get lost in the trees and forget about the forest. So that brings us to our napkin model. It's a much simpler and smaller model that focuses only on the essentials of the business, It is easier to build the tablecloth model than the napkin. But if we can build a napkin model, that means we understand the drivers of the business. We understand what matters. Models are important because they help us remain rational. It's only a matter of time before a stock we own will blow up, or, in layman's terms, decline. In this type of analysis, what happens this month, this quarter, or even this year is unimportant in the context of the long run, unless the company's good or bad earnings report in a quarter changes our assumptions on the company's long-term cash flows. If you methodically focus on what the company is worth, and if your total IQ is maximized, then price fluctuations are just noise. Volatility becomes your friend because you can rationally take advantage of it. It is an underappreciated gift from Mr. Market. Side note, as an investor, I feel it is one of my greatest responsibilities to be an honest and clear communicator. There is an asymmetry of information between us and our clients. We have invested weeks and months of research into the analysis of each stock. Therefore, we have a good idea of what each company is worth. Our clients have not done this research, and they should not have to. That is what they hired us to do. This is why we pour our heart and soul into our quarterly letters. We want to close this information gap, and so we try as hard as we can to explain what we think the companies in our portfolio are worth. Our letters are often 15 to 20 pages long. Number 6. In the long run, stocks revert to their fair value. Reversion to fair value is not a pie-in-the-sky concept. If a stock is significantly undervalued for a long time, this undervaluation gets cured eventually. This can happen through share buybacks. The company can basically buy all of its shares and take itself private. Or it can happen by the company's paying out its earnings in dividends, thus creating yields that the market will not be able to ignore. Or the company's competitors will realize that it is cheaper for them to buy the company than to replicate its assets on their own. Either way, undervaluation gets cured. This faith that undervaluation will not last forever is paramount to value investing. But this is not your regular faith, which requires belief without proof. This is evidence-supported faith with hundreds of years of data to back it up. Just look at the US stock market. It has gone through cycles when it was incredibly cheap and others when it was incredibly expensive. At some points in its journey from one extreme to the other, it touched its fair value, even if it was transitory. Historically, value investing, or owning undervalued companies, has done significantly better than other strategies. Paradoxically, the reason it has done well in the long run is because it did not work consistently in the short run. If something works consistently, and that's the key word here, everybody piles into it, and it stops working. These aforementioned cycles of temporary brilliance and dumbness are not just common to us mere mortals. Even Warren Buffett's Berkshire Hathaway goes through them. As just one example, in 1999, when the stock market went up 21%, Berkshire Hathaway stock declined 19%. In 1999, the financial press was writing obituaries for Buffett's investment prowess. Suddenly, in 1999, Buffett's IQ was lagging the market by 40%. At the time, investors were infatuated with internet stocks that were not making money, but that were supposed to have a bright future. Investors were selling unsexy old economy stocks that Buffett owned in order to buy the new economy ones. So if at the end of 1999, you were to sell Berkshire Hathaway and buy the S&P 500 instead, you would have done the easy thing. But it would have been a large, though very common, mistake. Over the next 3 years, Berkshire Hathaway gained over 30%, while the S&P declined over 40%. During the year 1999, Buffett's IQ did not change much. In fact, the book value of businesses Berkshire Hathaway owned went up by 0.5% that year. But in 1999, the market's attention was somewhere else, and it chose to price Berkshire Hathaway 19% lower. As a value investor, if you do a reasonable job estimating what the business is worth, then at some point the stock market will price it accordingly. You need to have faith. I am acutely aware how wishful this statement sounds, but this faith, the belief in mean reversion, has to be deeply ingrained in our psyche. It will allow us to remain rational when people around us are not. Conclusion. I read somewhere that chess is a game of small advantages. When the game starts, the players are equal. Both hold the same number of pieces in the same positions. But then every move either adds to your position or competitive advantage, or it subtracts from it. These little decisions, resulting in a better pawn structure, a more secure king, a centrally positioned knight, and so on, that you make with every move, accumulate into victory. Investing is not that much different, especially in today's world where access to information has flattened. A mutual fund that manages $100 billion may spend $100 million on research, but that $100 million doesn't buy any more than what a patient value investor can glean by reading financial statements. I am not talking about Warren Buffett either, who doesn't even have a PC in his office. Ted Weschler and Todd Combs, Warren Buffett's right-hand men, achieved phenomenal investment success without a fancy research department by simply reading carefully and following our 6 commandments. The key to succeeding in this irrational world is to actively ingrain each one of these principles into your investment operating system, improving your process just a little on a daily basis, and then success will follow. Finally, this would not be a worthy chapter if I did not contradict myself, just a little. Investing is also unlike chess. Investing affords us a luxury that few people appreciate. You can choose your own opponent. In chess tournaments, you don't get to choose your opponent. Tournament organizers match you to someone with an equal rating. Then as you win, you are progressively matched against better opponents. In investing, you are the tournament organizer. You get to walk into the room, and instead of choosing the geekiest opponent, the guy with thick glasses who hasn't been on a date in years and has only thought and dreamt about chess, you can go for the muscular guy who spends 5 hours a day in the gym and only joined the tournament because he lost a bet. Money doesn't know how you made it. $100 made by solving easy problems, like buying stocks where both your IQ and EQ were at their highest, buys as much as $100 that caused you to lose your hair. In investing, you don't have to solve the problems that everyone else is solving. There are thousands of stocks out there, and your portfolio needs only a few dozen. Thank you for listening. Vitaly's investment firm, IMA, uses the 6 commandments that you just heard to build low-risk, long-term oriented portfolios for clients. To learn more about IMA's investment process and one-of-a-kind client experience, visit imausa.com. Enjoy life and prosper.